First company we're going to look at is Levi Nike. So most people know these companies. Levi makes jeans. It makes all types of clothing plus some footwear. Nike does the same thing, mainly footwear, but a lot of clothing as well, and all over the world, both companies. So those are the ones we're going to look at today. Now, when we do a back test in PairTrade Finder and we're looking for good pairs to trade, we have to set group settings. And we'll take you through all of this in our video training course. However, there's a section here called Entry Stretch Layers, and this is where you can choose how you get into a trade and whether you layer in or whether you go in all in on one trade entry. So in this case, we've done one layer at 2.75 standard deviations entry at $10,000 a leg, and that's how this back test has been done. And this is the result. For Levi Nike, over 3 years, you get 4 trades. And here are our correlation and co-integration figures. So over 50% correlated, 0.87 co-integration. Basically, we call that co-integrated. But what we see is that it hasn't done very well. It did well for 3 trades, and then it had a loser, and now it's in a losing trade as well. Ratio's starting to trend, so it's actually a dangerous pair when it's trending like this. And the max drawdown is over 13%, so that's a very bad reward-risk ratio. So what happens? Were you to apply a layered entry to this pair, and over 3 years there were only 4 trades, let's look at what that would look like in backtest. So here it is. If we go to the group settings here, you'll see that we have one layer at 2.5 standard deviation entry at $5,000 a leg, and a second layer at 3.0 standard deviation entry at $5,000 a leg. If you see, the average of these would be 2.75 and $10,000 a leg, which is what we had for this first back test. However, when you look at it with this back test and those 2 layers of entry, what do you get? You see there were 7 trades, not 4. The compound annual growth rate of the capital was 10%, and the max drawdown was only 6%. And here you see the equity curve, a very, very different animal to trade. And what it's doing is it's protecting us when you have trending ratios and the like. And how do we know that? Well, if we go to our pair charts, I'd like you to focus on the core ratio chart here. Here you're seeing the entry and the exit of the previous trade to this one. And then here you're seeing the entry that's just happened with this trending ratio. And you can see it entered at negative 2.8, and it almost came good. Okay, 554 profit, but then it started to fade away, and now it's fading again as well. As you can see, it almost came good, and then started fading away. So this is now $356 in loss. Let's look at what happened with the layered entry strategy. Well, here we got one layer of $5,000 at 2.6 standard deviations, and here we got another layer at 3.09 for another $5,000. So you're getting a better average entry than you did in the other, and you're also protecting yourself from the losses on the full 10,000 that would have occurred as the ratio trended down. What does that mean? Well, at one point this trade was up 623 and almost exited, and it is decaying as we know, but even though it's decaying, it's only got a $148 loss versus $356 with the single layer entry. And who knows what's going to happen in the market with this trade going forward. However, what this does show you is how you can increase your profitability, how you can lower your max drawdown, and when looking at this back test, how you can turn a poor reward risk pair that you wouldn't select into one that potentially you would select. So these are the types of things we learn in our online video training course when you sign up for a free trial to Ultimate Alpha 3.0. Happy trading, everyone.